blue of the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Banking is going through an exciting phase of evolution. Knowledge about these developments is important, but a greater emphasis needs to be placed to understand them and put them in context. Good morning, I'm Ishan Gera. Starting today, Business Standard will bring you stories of developments and personalities from banking, insurance, and financial sectors. Watch the Business Standard Banking Show every Thursday for analysis of the most important banking news and interviews with people who understand the landscape the best. Let's take a look at the most important banking developments of this week. The HDFC Bank recently reported higher earnings growth in January-March quarter but lower margins. While it was a strong performance for India's largest private sector lender, the reason for a margin drop was its change of tack during the pandemic. As the retail segment suffered, the bank extended more loans to the wholesale segment. The strategy lowered its net interest income growth but helped it grow the advances during the fourth quarter by 20.8% over a year earlier. While it may be a prudent approach, this strategy will be tested in coming months as the RBI tightens its monetary policy. Talking about policy tightening and the risk of non-performing assets, the insolvency route has not really turned out to be the success that the government had hoped for. Data released by the Insolvency and Bankruptcy Board of India showed that less than a third of debt was recovered by lenders via insolvency cases. In nearly half of these cases, liquidation was the solution. Resolution through lender-approved plans remained a problematic approach, with just 457 of the 3,247 cases being settled by this method. Worse, 1 in every 5 of these cases were pending review or appeals. If one considers NPAs and companies under financial stress, NBFCs were the worst hit during the pandemic as loan collections declined and NPAs started rising. However, many now expect a growth revival for NBFCs. So it is not surprising that Godrej Group, one of India's oldest corporate houses, has announced its plans to operationalize its NBFC license after 24 years. While its housing finance division was recently announced, it now aims to expand the base. The target is to build a 30,000 crore rupee balance sheet by 2026. Its first target is the unsecured loan segment. The announcement of Godrej Housing Finance had coincided with the launch of WhatsApp payments in November 2020. WhatsApp payment service onboarded more users in June 2021 and rallied for inclusion of even more. The NPCI has now allowed WhatsApp to expand its user base by another 60 million to 100 million. While the messaging platform accounts for only 0.05% of UPI transactions, it is banking on widespread adoption as a messaging platform to bolster its chances to upend the likes of Google Pay and PhonePe. The expansion of its payment mechanism will also provide its parent, Meta, more room to foray into social commerce and predict consumer behavior better. We all know what a challenge is onboarding customers and retaining them. But few understand this better than Centrum Group Chairman Jaspal Bindra, who initiated the process of establishing the Unity Small Finance Bank along with Bharat Pay. Our banking editor, Manojit Saha, spoke to Bindra. Let's listen in.
Welcome to the show, Mr. Bindra. Now that Unity Small Finance Bank has paid the first tranche to the depositors of PMC Bank, which was a priority, what is your long to medium term roadmap for Unity Small Finance Bank?
The Unity Small Finance Bank is, as you know, just got started, and the first leg of our journey is integration. So we've integrated two businesses from Centrum into the bank, the microfinance and the MSME business. That was done in November, starting November last year. In January, we got the approval to transfer the assets and liabilities of PMC Bank into Unity as well. So that work is in progress. And we are soon going to begin the integration of the Bharat Pay liability side and the asset side business into the Unity Bank. So the first phase of the journey is integration of these three different entity businesses into Unity Bank. And once we've stabilized that, then it's about growing scale in the business. We want to be a predominantly retail and predominantly digital bank. That is, all our offerings will be available to the customer on the iPhone app, tablet, etc. And clearly it will be available 365 days, 24/7, etc. So that is the longer term objective.
Apart from the two businesses which you're inheriting from PMC Bank, which are the new lines of businesses in terms of credit that you're planning to launch?
So that is work in progress right now. We are evaluating several businesses. We will do at a time a few products, things where we think we have sufficient competitive advantage to scale. So we will start with a few of those to begin with and then gradually increase, but it's not going to be a full launch of everything at one time.
And recently there was a ICRA ratings when they assigned the rating to to Unity Small Finance Bank. They have noted some of the expected losses arising in the medium term because of the high integration cost and operational cost. When do you see Unity Small Finance Bank start making profit?
So we think operationally we'll be profitable very quickly.
Okay.
In fact, because the businesses that we are integrating from Centrum are already profitable. The businesses we will integrate from Bharat Pay are already profitable. Most of the businesses that we are going to inherit from PMC Bank are going to be run down to liquidation. So because they are wholesale business, we don't want to run those in our books. So I think operating wise we'll be profitable, but because of the debt repayment, the deposit resolution, we might have to provide for those payments. So from that point of view, even though it will not be a cash loss, it will record in the accounting books as a negative for a few years.
I think as a small finance bank, you are also mandated to go for an IPO once your net worth crossed 500 crore. You started with more than 500 crore. So an IPO should be there in the 3 years. So from that perspective, I was wondering that is the IPO is there in your mind already, and is there a roadmap?
So the IPO is we are allowed 5 to 6 years after the capital that you mentioned has been achieved. So we have some time. We will be profitable well before the IPO date.
Tell us something about the deposit mobilization, how it is going, because the main objective of starting a bank is to get the low-cost deposits. So how has been your experience in mobilizing deposits?
So we are happy to say that out of the payout that we made of approximately 4,000 crores, more than 2,000 crores is retained with the bank. So we already have a starting deposit of 2,000 crores today.
Okay.
And that might vary over the near term by a few hundred crores plus minus. But that's a very good start to on day one. In the first very few months to have a 2,000 crore deposit, I think is already a very good start. And we hope to build from here. Is
there any particular strategy you're adapting to attract new depositors, like offering higher rates on savings products?
So I think that's a given. We have to be competitive. We're a new entrant, so on interest rates we have to be competitive. But over time, we hope we are able to generate enough service quality and good experience, create goodwill, build trust in the new management over time, explore new sources of deposits, etc., to make our deposit mobilization program successful.
Do you have any plans to raise funds in the near term?
So we are self-funded so far our equity. And currently we seem to be comfortable both on capital and on liquidity. But as you well know, banks are a guzzler for capital. So one of the trade-offs of good growth is also increased need for capital. So yes, we'll be coming back for raising capital, but we have the first 3,000 crores committed by the promoters themselves. And beyond that, as and when the call comes, we will have to go and raise capital. But we think for the first 2-3 years, we are well provided.
The first tranche of payment which was made to PMC depositors was provided by the DICGC. So, but every year there will be some money to be paid. So how do you plan to raise that resources?
We've done the calculations on the payout as per what was dictated by the scheme. So we have to make that arrangement. But we think if we can keep a steady growth, we will have sufficient generation of cash flow to pay. So some combination of healthy deposit mobilization and some good movement on the performance will hopefully leave us with enough liquidity to meet our obligations.
So what is your experience on retaining the PMC Bank depositors?
So like I said, of the first lot, more than 50% have stayed. So far, it's been about 3 weeks since we released the money, and more than 50%, actually 60% as of today, are still with us. So we hope that that trend doesn't change too much now, because I think we saw in the first 5 to 7 days a lot of movement. Now the movement has more or less plateaued. There might still be another 5, 10, 15% who move away, but I think the bulk of the people who had to move away have done, and we are hoping that the rest are likely to stay with us.
Interest rates are certainly going to rise. So what is your view on the interest rate outlook, the overall interest rate? We have seen a benign interest regime for the last 2.5 years, in fact more than 2 years now. Now things are changing. The Russia-Ukraine war has completely changed the atmosphere. So what is your take? How fast do you think interest rate for the entire economy going to move?
I think if I had to sort of make some prediction, I would say the interest rates are unlikely to fall from here for sure. So I think that trend is now clear. How quickly and at what frequency they will go up, by how much, is difficult, because I think the world is in quite a dynamic place. There is the threat of inflation on one hand. There is the war going on the other hand. There is still the lag and lead effect of the pandemic within the country, especially in the informal sector. So I think, there has been a lot of disruption in the logistics of the supply chain around the world. So I think all of these factors are playing a role. So I think it is going to be a tough job for the RBI, but I think they will have to straddle and play according to, finding the right balance between inflation and all the other challenges that borrowers are facing in the market today.
Governance is one of the issues which has been in the discussion for the last few years. We have seen the experience for some of the banks as the reaction of RBI to the governance issues. How will you ensure governance in Unity Small Finance Bank remains the best in class?
Well, I think if we go with the mindset that compliance is not an option and not a nice thing to have, then I think then it doesn't become such a burden. If you think of it as, we also have to do compliance, then it becomes a challenge, and then sometimes there is a mood to shortcut it. But I think we just have to accept that that's part of the package, that the compliance, corporate governance just have to be at a level that is acceptable and more. Otherwise, the pain of, recovering from a compliance lapse or from a poor corporate is too much. And now we have so many examples in front of us. So it is very easy to understand that. Earlier, people said, nothing happens, what happened, nothing is no problem. But now I think we have seen enough examples, and we've seen the reaction of the courts, we've seen the reaction of the regulators, we have seen the feedback and the response from the shareholders, the depositors, everyone. So, there is no stakeholder who's going to spare you. if you do it wrong on will by neglect. So I think one just has to go with that learning and make it happen.
Thank you, Mr. Bindra, for speaking to us.
My pleasure. Thank you so much.
To establish and run a bank, one has to follow the guidelines laid down by the Reserve Bank of India. Banks have to maintain a CRR and an SLR ratio and also keep track of instruments like the Marginal Standing Facility and the Liquidity Adjustment Facility. In its latest monetary policy meeting, the RBI introduced Standing Deposit Facility or SDF, which is yet another instrument to absorb liquidity from the market. Our experts explain how this new instrument will impact banking.
In its April review of the monetary policy, the Reserve Bank of India introduced the Standing Deposit Facility or SDF to absorb excess liquidity without any collateral and increase interest rates in the money markets. So, what is this instrument and how will it work? At present, there is a liquidity overhang to the tune of 8 trillion rupees in the system. This will be sucked out gradually in line with the RBI's plan to withdraw from the accommodative stance that has been in force since the start of the COVID-19 pandemic 2 years ago. Now, as inflation increasingly becomes a concern with geopolitical tensions causing a surge in prices of commodities like crude oil, the central bank has turned its focus on its primary mandate, controlling inflation. 8 years ago, a committee headed by the then RBI Deputy Governor Urjit Patel had recommended SDF as an instrument to drain out liquidity. The Patel Committee had, among other things, recommended an inflation targeting framework for the monetary policy. This later became a law after being voted by Parliament. After the introduction of the SDF, banks will now park their money with the RBI at the SDF rate, and for that, they will not get government securities as collateral. Since the SDF rate is 3.75%, the policy repo rate 4% and the MSF rate 4.25%, the width of the Liquidity Adjustment Facility or LAF corridor stands restored to the pre-pandemic level of 50 basis points. The policy corridor had been widened to 90 basis points during the pandemic. The introduction of the SDF also makes reverse repo rate defunct. Since SDF is the floor rate, the effective interest rate will be 3.75%. The reverse repo rate is at 3.35%. So the effective interest rate rises by 40 basis points. The SDF at 3.75% also marks the beginning of monetary policy normalization according to central bank watchers. The RBI also guided that the focus going ahead would be on a withdrawal from the accommodative stance. Under the accommodative stance, the RBI either lowers or holds rates. It does not increase interest rates.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
The SDF will act as a floor for the LAF corridor. To understand the need for this new instrument, I had a conversation with Dr. Renu Kohli, who's an economist. Let's listen into her views on this and the latest RBI policy and other rumblings in the banking sector. Hello, Dr. Kohli. Thank you for coming on the show. We were just discussing the new instrument launched by the RBI governor. The standing deposit facility, unlike the reverse repo rate, lets RBI absorb liquidity from the market without keeping G-Secs as collateral. How will this alter the landscape and why introduce it now, 8 years after it was recommended?
I think the timing is important. For one thing, it's 8 years ago it was recommended and the RBI had been wanting it for very long, but it came from a standpoint more of external capital account management and managing excess inflows. Currently, however, that is not the main issue. If at all, actually global financial conditions are tightening and the capital flow cycle, as we have seen already in the last several months, is reversing. My sense is that the situation is more domestic in the context of large government borrowing and unprecedented liquidity that the Reserve Bank has injected into the economy in the wake of COVID, and even before that into long-term repo operations and etc. So now that the time is for reversal. So for the RBI to introduce it now, I think it is probably that it provides it greater flexibility. It probably wants more GSECs with it at its disposal to give it more flexibility for monetary policy operations ahead, because the times are very uncertain. It has to scale back liquidity.
Now, coming back to the monetary policy decisions that we discussed right now, India has maintained its monetary policy stance while the developed world is raising its rates. How do you see the risks coming to the economy from this interest rate differential? And do you think RBI should be more hawkish about its stance?
About the interest rate differential, I think we have seen actually the developments in the last several months, and particularly at the end of the year, that directionally the risks are very clear, which is exit of capital, drawdown of reserves. The RBI, as far as if I've got the numbers correct, it is already, the reserves are down by some $30 billion already has been sold. And not just that, it's also the external position has also, it is reflected in that import cover is down to 12 months and so on. So what we have not seen so far is actually the pressure upon the exchange rate. So, and if that comes about because of the current account deficit widening or sudden unexpected slowdown in exports, then things could aggravate. So, these are the usual problems that we see of a widening interest rate differential between the domestic and the foreign interest rates. And the situation is quite apparent. As far as hawkishness is concerned, whether it should be more hawkish, I think it is operating in an inflation targeting regime, and it has very little choice, or rather, it has no choice except to adapt or move in consonance with its forecast. And the price shocks, particularly from oil and energy and food prices, have compounded. Plus, the uncertainty about the evolution of prices is very high. So it has no choice except to be hawkish. How hawkish should it be? It has indicated, the governor has indicated very clearly that the interest rates have to turn real. They have to move towards that. Now, within that movement, I think that I would say that it has all the tools, as it said. It is in a position, it has already communicated that we will act as and when it's required, and whatever needs to be done, we will do it. So let me put the question this way: can it be blindly hawkish? I think not, because unlike the advanced countries, the demand conditions in India are extremely weak.
Now, we have mentioned inflation targeting at least thrice now. Now, has the inflation targeting failed, or is there a problem with that approach? And you've written about it a lot. This is something that you've rallied about a lot.
I have written a lot about it, and I'm one of those who actually argued against its introduction way back in 2013 and 14. In fact, from 12 onwards, there was this talk about shifting to CPI as an anchor. And I had my reasons, and they are there in the public domain. But coming back to your question about success or failure, see, it was introduced formally in 16 and informally in 14. I think it's too short a period to declare the success or failure of any particular new monetary policy regime. And we haven't gone through, it has not been exposed to different kinds of business cycles. And more than that, different kinds of shocks, because it's a forward-looking regime and it affects the inflation with a lag. And it's essentially a targeting of an inflation forecast. We have already seen how the US Fed has got it wrong from its readings of inflation about transitory, etc., from last year. Expectations have begun to rise in the West also, although in the long term, expectations still remain somewhat lower. But we need to, I think it's a test because it's a reversal after 30 years. The inflation expectations do not get de-anchored and they continue, or in fact, if they are re-anchored, because the US Central Bank has to make a very steep adjustment. It has to bring down inflation by as much as 4 percentage points. And if it can do that without driving the economy into a recession and re-anchor expectation remains, if that happens, then I would say it is a great success. And I think the same applies to India. One more point is that we haven't seen, it was argued, one of the strongest arguments for introduction of IT was that low stable inflation will yield long high growth rates, sustainable growth rates for long years, many years to come in the future. We haven't seen that. Macroeconomic stability and price stability hasn't brought growth in India.
Now, coming back to the RBI forecast, the last financial stability report had said that the capital to risk weighted asset ratio of SCBs had improved. The provisioning coverage ratio was also high, but it had also pointed out that the NPAs would rise next year. And also there's stress in MSMEs. Are we looking at a balance sheet crisis because of the aggressive monetary tightening and the low growth?
Things. One is, I think the balance sheet crisis would be a little far off to speculate upon. I think the chances of that are lesser because we have seen that the corporates have deleveraged, for number one. And number two, there hasn't been much lending in the last 2 years. Past debts. Past debts, most of the corporates actually took the benefit of equity and corporate bond market because the market rates were so much lower than bank lending rates. So they actually exchanged their loans. So those are fine. Now we come back to the MSMEs. Frankly, no one knows what's the situation of MSMEs because even before the pandemic, the MSME debt and loans have been under regulatory reprieve for a very long time. I think from 2019 onwards. So that's what we are now 4 years. And even now, the high lending that we are seeing in the monthly data, in bank credit data, includes that the emergency credit lines which have been given out, extended by the government in the wake of the pandemic. So inclusive of these restructuring and the guarantees that the government has held out, we do not know. And we also do not know what is the NBFC lending position. Bank credit, we know. But we don't know, and we also know that the banks have extended a lot of lines to the NBFCs. Overall, I would say that the balance sheet crisis feedback, there is one source of pressure upon the banks. Let me just conclude that by adding that the holdings of government debt are very high, unprecedented, because government debt has increased, borrowings are very hugely elevated. So the reversal in the interest rate cycle will, of course, impact the bank's feedback upon the bank's balance sheet. But definitely a rise in interest rates affects the bank's balance sheets and their, their earnings and the interest margins.
Thank you, Dr. Kohli. We hope to soon have you back again. Thank you for coming on the show. An aggressive monetary policy will come with its own concerns. And with terms of trade turning unfavorable again, the government and the RBI will have to walk the tightrope, balancing growth and inflation concerns. That's all for this week. We'll be back at 11 a.m. next Thursday with more news and analysis. Do subscribe to our YouTube channel for more updates, and thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.